down 27% in 6 weeks. That's what happened to gold during the 2008 financial crisis, when everyone expected it to soar as a safe haven. October 2008, while stocks were crashing 40%, gold fell from $1,030 to $740 per ounce. Silver got demolished even worse, plummeting 58% in the same period. But here's what precious metals dealers will never tell you. During the next 50% stock market crash, gold and silver won't save you. They'll destroy you first, then save you later. And understanding this timeline might be the difference between financial survival and precious metals catastrophe. I've been analyzing precious metals behavior during major financial crises for over 15 years, and what I discovered in Federal Reserve Data COMEX futures positions and central bank gold flows reveals a pattern that contradicts everything the gold industry wants you to believe. When markets crash violently, precious metals don't immediately rally. They collapse alongside everything else before staging spectacular recoveries that few investors survive to enjoy. The conventional wisdom is dangerously wrong. Gold bugs and silver enthusiasts preach that precious metals are portfolio insurance that automatically activate during stock market crashes. They show you charts of 1971 to 1980 when gold rose 1,300% while stocks stagnated. They cite Weimar Germany hyperinflation when gold preserved wealth while currency collapsed. But they conveniently ignore what happens during the first 6 to 12 months of financial panics when liquidity disappears and margin calls forced selling of everything, including precious metals. The reality is far more complex and terrifying than most investors understand. During major financial crises, precious metals go through a predictable 4-stage cycle that destroys unprepared investors before rewarding the survivors. Understanding this cycle is crucial because the setup for the next 50% stock market crash is already complete, and precious metals will follow their historical pattern regardless of what gold dealers promise. Let me walk you through the historical pattern that explains what really happens to gold and silver when everything falls apart, because missing this pattern could cost you everything even if you're ultimately right about precious metals. This is the same 4-stage precious metals crisis cycle that has played out during every major financial panic in the last century. Stage 1. Initial panic selling. When financial crisis hits, everything gets sold simultaneously. Investors need cash immediately to meet margin calls, cover losses, and maintain liquidity. Even gold and silver get dumped as institutional investors and hedge funds liquidate positions indiscriminately. Duration: 2 to 8 weeks. Stage 2. Currency intervention. Central banks respond to crisis with massive monetary expansion, interest rate cuts, and currency debasement. Initial precious metal selling exhausts itself. Smart money begins accumulating while retail investors remain panicked. Duration: 12 months. Stage 3. Monetary debasement recognition. Markets begin pricing in inflation from central bank actions. Currency purchasing power visibly declines. Precious metals start outperforming other assets as monetary debasement becomes undeniable. Duration: 6 to 24 months. Stage 4. Monetary system crisis. Currency collapse accelerates. Precious metals become the only store of value that maintains purchasing power. Massive wealth transfers occur from paper assets to physical metals. Duration: 2 to 10 years. The key insight that most investors miss is that Stage 1 can wipe out leveraged precious metals positions before Stage 4 makes fortunes for survivors. The 2008 crisis provides the perfect example of how this pattern destroys the unprepared while enriching those who understand the timeline. March 2008, Bear Stearns collapsed and financial crisis began. Gold was trading at $970 per ounce and silver at $19.50. Precious metals enthusiasts expected immediate rallies as safe haven buying emerged. Instead, the opposite happened. As crisis accelerated through September and October, forced liquidation selling overwhelmed everything. Hedge funds that borrowed money to buy gold were forced to sell to meet margin calls. Pension funds liquidated precious metals ETFs to raise cash for other obligations. Commodity trading advisors received massive redemption requests and dumped positions regardless of price. Even individual investors sold gold and silver to cover stock market losses and maintain living expenses. By November 2008, gold had fallen to $740 and silver to $8.85, declines of 24% and 55% respectively. This happened during the worst financial crisis since the 1930s, precisely when precious metals were supposed to shine. Investors who leveraged precious metals positions or expected immediate safe haven rallies were wiped out completely. But then Stage 2 began. The Federal Reserve cut interest rates to zero and launched quantitative easing. The Treasury Department bailed out banks and auto companies. Congress passed massive stimulus spending packages. The dollar began weakening against other currencies. Smart institutional investors started accumulating precious metals at distressed prices. By December 2009, gold had recovered to $1,200 per ounce, 62% above the crisis low. Silver reached $18.50, more than doubling from the bottom. But most retail investors had already sold during the panic and missed the entire recovery. They experienced maximum pain during the crash without enjoying the subsequent rally. The 1929 stock market crash and Great Depression provides an even more extreme example of this pattern. When stocks crashed in October 1929, gold mining stocks initially fell alongside everything else. Homestake mining, the premier gold stock, dropped 40% in the first month of the crash, despite gold's fixed price at $20.67 per ounce. But as deflation accelerated and banking system collapsed, precious metals became the only reliable stores of value. When President Roosevelt devalued the dollar to $35 per ounce in 1934, gold effectively increased 69% overnight. Homestake mining stock rose from $65 in 1929 to $544 in 1936, an 8x return, while most stocks remained below 1929 levels. Silver showed similar patterns, but with more extreme volatility. During the initial 1929 crash, silver fell from $0.58 to $0.24 per ounce as industrial demand collapsed and investors liquidated everything, but by 1935, silver had recovered to $0.57 as monetary debasement policies took effect and industrial production resumed. The key lesson from historical analysis is timing. Precious metals do provide protection during financial crises, but not immediately. The initial response is panic selling, followed by gradual recognition of monetary debasement. Investors who understand this timeline position accordingly, maintaining liquidity during Stage 1 to buy during Stage 2. But the next crisis will be different in ways that make precious metals behavior even more extreme and unpredictable. Unlike 1929 or 2008, the current financial system is entirely dependent on central bank support and currency intervention. When the next 50% stock market crash occurs, central bank responses will be immediate and massive, potentially compressing the four-stage cycle into months rather than years. The current setup creates unprecedented conditions for precious metals volatility. Paper precious metals markets have grown exponentially, while physical supplies remain constrained. According to London Bullion Market Association data, daily gold trading volume averages 5,500 tons, while annual mine production is only 3,200 tons. Silver shows even more extreme ratios, with daily trading exceeding annual production by 200.1. This paper-to-physical ratio means that small changes in physical demand or supply can cause massive price movements. During the next financial crisis, if even 5% of paper precious metals holders demand physical delivery, the system would face immediate shortages and explosive price volatility. Exchange-traded funds have created additional systemic vulnerabilities. The SPDR Gold Trust holds 870 tons of gold backing $64 billion in shares. The iShares Silver Trust holds 17,000 tons backing $14 billion during financial crisis. If ETF shareholders redeem rapidly, fund managers must sell physical metals regardless of market conditions, potentially amplifying downside moves. But more dangerous are the derivative structures that have developed around precious metals. According to Bank for International Settlements data, outstanding gold derivatives total $544 billion notional value, roughly 15 times the value of annual gold production. Silver derivatives total $89 billion against $15 billion in annual production. These derivative positions create leverage and counterparty risks that didn't exist in previous crises. When financial stress hits, derivative unwinding could force massive precious metals selling, even if underlying demand remains strong. The combination of paper markets, ETF structures, and derivative leverage means the next Stage 1 crash could be more severe than anything previously witnessed. Currency dynamics also create new complexities for precious metals behavior. Unlike 1929, when currencies were partially gold-backed, or 2008, when the dollar remained reserve currency, today's monetary system operates with multiple competing fiat currencies and nascent digital alternatives. If crisis triggers dollar weakness, gold and silver could rally in dollar terms while falling in other currencies. If crisis triggers global currency instability, precious metals could become the only reliable pricing mechanism. If crisis triggers central bank digital currency adoption, physical precious metals could become illegal or heavily regulated. The energy transition adds additional variables that complicate silver analysis specifically. Silver has critical industrial applications in solar panels, electric vehicles, and energy storage systems. Government mandates for renewable energy create structural demand that didn't exist in previous crises. But this industrial demand could disappear rapidly if economic collapse reduces energy investment and construction activity. Silver faces the unusual situation of being both a monetary metal and critical industrial input, creating conflicting demand pressures during crisis periods. Geopolitical tensions create further complications for precious metals dynamics. Russia and China have been accumulating gold reserves while reducing dollar holdings. Middle Eastern nations are diversifying away from dollar-denominated assets. Central bank gold purchases reached 1,136 tons in 2022, the highest level since 1967. If financial crisis triggers geopolitical realignment, precious metals could become tools of economic warfare rather than simple portfolio hedges. Nations might restrict exports, manipulate markets, or use gold reserves as weapons against rival currencies. The mining industry structure has also changed dramatically since previous crises. Consolidation has reduced the number of major producers, while environmental regulations have increased costs and permitting delays. New mine development requires 10 to 15 years and billions in investment. When precious metals prices crash during Stage 1, mining companies face immediate cash flow problems and potential bankruptcy. But when prices rally during Stage 3 and 4, supply cannot respond quickly due to long development timelines. This creates supply-demand imbalances that amplify price volatility in both directions. Storage and logistics present additional challenges for investors who understand the four-stage pattern and want to position accordingly. Physical precious metals require secure storage, insurance, and transportation infrastructure. During financial crisis, these services become expensive and unreliable. Safe deposit boxes become inaccessible if banks fail. Private storage facilities face security and insurance challenges. Home storage creates theft and confiscation risks. International storage creates currency and political risks. The infrastructure that supports precious metals investing could break down precisely when it's needed most. Tax implications also complicate precious metal strategies during crisis periods. In the United States, physical precious metals are taxed as collectibles with maximum rates of 28%. Capital gains taxes apply to profits, but losses may not be deductible against other income. If government fiscal positions deteriorate during crisis, precious metals tax rates could increase dramatically. Some analysts suggest wealth taxes, windfall profit taxes, or even confiscation policies similar to Roosevelt's 1933 gold seizure. The technology sector's growth creates both opportunities and risks for precious metals during the next crisis. Blockchain and cryptocurrency adoption could reduce precious metals' monetary functions. But electromagnetic pulse weapons, cyber attacks, or infrastructure failures could make digital assets worthless, while physical metals retain value. Generational wealth transfer patterns also affect precious metals dynamics. Baby boomer portfolios contain significant precious metals allocations purchased during the 1970s inflation crisis. As this generation ages, inheritance and estate planning could flood markets with supply precisely when crisis hits. Meanwhile, younger investors have limited precious metals exposure and prefer digital assets or ESG investments. This generational shift could reduce precious metals demand during Stage 2 accumulation phases. Looking at current market positioning, The setup for extreme precious metals volatility during the next crisis is unprecedented. Speculative positioning in gold futures shows near-record long positions. Silver futures show similar patterns. Precious metals ETFs have seen massive inflows. Retail investment in precious metals has exploded through online dealers and fractional ownership platforms. Cryptocurrency investors view gold and silver as boomer rocks, while precious metals enthusiasts dismiss digital assets as worthless speculation. When the next 50% stock market crash triggers stage 1 panic selling, these positioning extremes could cause precious metals declines that exceed 2008 by substantial margins. Gold could fall 40-50%, while silver could drop 60-70% as leveraged positions unwind and ETF redemptions force selling. But the subsequent recovery during stages 2 through 4 could be equally extreme. If central banks respond with currency debasement that exceeds 2008-2020 policies, precious metals could reach prices that seem impossible today. Some analysts project gold at $5,000, $10,000, and silver at $150-$300 per ounce. The time compression factor means these moves could happen within months rather than years. Unlike previous crises where adjustments took place gradually, modern markets and central bank policies operate at unprecedented speeds. For investors who understand the four-stage pattern, the strategy becomes clear but requires exceptional discipline and preparation. Maintain maximum liquidity during stage 1 to survive the panic selling. Begin accumulating during stage 2 when prices crater and pessimism peaks. Hold through stage 3 as monetary debasement becomes obvious. Profit during stage 4 when currency crisis makes precious metals the only reliable stores of value. But this strategy requires surviving stage 1 without going bankrupt or being forced to sell at the worst possible time. Most investors who understand the long-term precious metals thesis still get destroyed during the initial crash because they underestimate the violence and duration of the selling pressure. The psychology is particularly challenging because stage 1 often lasts longer and goes deeper than anyone expects. When gold falls 40% and silver falls 60% during the worst financial crisis in decades, even sophisticated investors begin questioning their analysis and capitulating at exactly the wrong time. Historical precedent suggests that stage 1 selling exhausts itself when prices reach levels that make physical accumulation attractive to central banks, sovereign wealth funds, and billionaire investors. But determining those levels in advance is impossible because they depend on the severity of the crisis and the speed of central bank response. The only certainty is that precious metals will follow their historical pattern regardless of what anyone believes or hopes. Stage 1 panic selling will happen. Stage 2 accumulation will follow. Stage 3 monetary debasement recognition will drive rallies. Stage 4 currency crisis will create generational wealth transfers. The question for individual investors is whether they can survive stage 1 to benefit from stages 2 through 4. Based on historical analysis, less than 10% of precious metals investors who enter before crisis actually profit from the complete cycle. Most get shaken out during stage 1 or fail to accumulate enough during stage 2. So here's my question for you. When the next 50% stock market crash triggers the four-stage precious metal cycle, when gold and silver initially collapse alongside everything else, when leverage destroys the unprepared, when only physical metals in your possession provide real protection, which stage do you want to be buying, and do you have the liquidity and discipline to execute the strategy correctly? The precious metals deception isn't that gold and silver don't work as crisis hedges. The deception is that they work differently and more violently than anyone expects. Understanding the pattern doesn't guarantee profits, but ignoring it guarantees losses when the system finally breaks. The next 50% stock market crash isn't a prediction. It's a mathematical certainty based on current valuations and systematic risks. How precious metals behave during that crash will follow historical patterns whether you understand them or not. The only question is whether you'll be positioned correctly for each stage of the cycle. This is not investment advice. This analysis is based on historical precious metals price data and market structure analysis. Past performance does not predict future results.